So now we look at some properties of bonds that are kind of interesting. Um, so if you look at these different rates, we've kind of looked at our base case scenario of 10%. And so if you had a $1,000 par value bond and the rates don't change, in 1 year it would be $1,000 would be the price. And in 10 years it would still be $1,000. And this is a 10-year bond, so that's when it would mature. Now, if we looked at if interest rates went down by 5% or if interest rates went up by 5%, let's see what would happen to the change in price for the bond. So if the interest rate goes down by 5%, then the price will go up because bonds have that inverse relationship between prices and interest rates. And so we get to 1,048. If we have a 10-year bond, then if interest rates go down by 5%, it goes up by a lot more to the price goes to $1,386. So you can see that this change is only 4.8%, whereas this change is 38.6%. So if I were you and I was going to invest in a bonds when interest rates were going down, I would want the 10-year bond because I get a huge capital gain compared to just a 1-year bond. Then we can look at the opposite situation. What if interest rates went up? We know bond prices should go down. Well, bond prices go down for the 1-year bond, decreasing by 4.4%, but for the 10-year bond, the bond price decreases by 25.1%. So if interest rates were going to go up, I would want the 1-year bond, a short-term bond, because then my losses wouldn't be so bad. And this is assuming that I have to be invested in bonds and, there was no way I could get out. It's part of my portfolio that I have to manage. So you can see the 10-year bond has more price risk or interest rate risk, and that just means that the percentage change in the price of the bond is much more volatile for a longer term bond than it is for a short term bond. And also another thing you can notice is that even though this was a 5% decrease and a 5% increase, the changes in the bond prices are not symmetrical. They're not both plus 38.6 and minus 38.6. Every time bond price or interest rates go down, bond prices go up by more than they would go down if interest rates went up. So this is like an asymmetrical result for changes in bond prices. And this is just a graph showing that result for the 1-year bond, as interest rates went down versus went up, and the 10-year bond. So just a graph for the previous slide that we looked at. So we just looked at price risk, and now we're going to look at reinvestment rate risk. So reinvestment rate risk for investors is the risk that interest rates go down. So if interest rates go down, then in the future when you get your money out of a previous investment, you face lower interest rates for your next investment. So an example is something wonderful here. I guess suppose you just won $500,000 playing the lottery, which is really not the best advice, but you won $500,000 and you're going to invest the money and live off the interest. So here's two types of options you could do. You could invest in a 10-year bond or 10 1-year bonds. And let's say that right now both 10-year and 1-year bonds have interest rates of 10% that you could make. So if you invest in the 1-year bond, then you get 10% of $500,000 or $50,000. And so that's pretty good. You can live on $50,000. And then at the end of year one, you've got to find another investment. So the problem here, and this is the reinvestment rate risk, if the 1-year rates fall down to 3%, then your income level is going to fall to 3% times 500,000, or you would now have a $15,000 salary you would have to suddenly live on for year two. Now, if you choose the 10-year bond strategy and you have the 10% interest rate, then you'll get the $50,000 for 10 years. And of course, that's assuming that the company can't call the bond back, but that would be a really good deal if you could get the 50,000 for 10 years. Now, this is all depending on the current interest rates in the market. It might be that right now interest rates for a 10-year bond are really low, and interest rates for everything are really low, kind of like they really are right now. And it might be better to invest in the 1-year bond because you're hoping interest rates will go up. And if you lock your money up for 10 years at a low interest rate, then you miss out on whenever interest rates do go up and you could reinvest. So reinvestment rate risk is really just the risk that interest rates go down, and that's assuming that they're at a good level to begin with. So in terms of the two types of risk we were talking about, we can kind of divide it into the categories of bonds. So price risk was the first one, and that's the risk that interest rates go up and that bond prices go down. And reinvestment rate risk is the risk that interest rates go down and you face a lower reinvestment rate. So for price risk, if you have a short-term or high coupon bonds, your price risk is low. And then for reinvestment rate risk, it's very high because we were just looking at that one example that showed that. And for long-term and low coupon bonds, price risk is very high. We saw how the 10-year bond had a much more drastic decrease in price of like 25% than the short-term bonds. So a strategy here is, if you think that interest rates are going to go down, you should invest in the long-term bonds, and even better, long-term bonds that have low coupon rates, because then you'll get the most maximum gain in price in the bond that you could get. And then if you think interest rates are going to go up, then you should invest in short-term high coupon rate bonds, because then you'll get the most minimal negative impact to your investment. And then overall, because we have these two risks, no matter what you invest in, you will face some sort of risk.